I always wonder if that's appreciated or not. Anyway, I'm going to run through chapter 8, and I'm not going to go through um, the notes for the beginning part. I'm just going to kind of go through and explain the different points that are in there, and then I'll go through the petty cash part. So the first part of it talks about internal control. Those are all the different things that are used to make the best use of resources while protecting the resources of the company, minimizing errors, and having accurate records, right? So obviously all of those things are needed. If we just think about a bank, because a bank I think is probably the easiest example for one of these. So you want to make sure that you're using all of the things that you have at the bank to go towards what a bank is there for, and that's to make money. So they want to make sure all their resources are working at full capacity. They don't want errors in the bank, because if you make an error, right, that's going to cost you money. Same thing with any business. Protection from fraud in a bank is a huge thing, right? Can't have people passing phony checks. You can't have people stealing money. You can't have forgery. You can't have counterfeiting, all that kind of stuff. And then, of course, you have to have accurate bank records in any business, because if you do it on purpose, make inaccurate records on purpose, then that's illegal. But beyond that, it's just a record of your business transactions, and therefore to make future plans, you need to have accurate ones of what you've done and what has happened and all that kind of stuff. Okay, so what does that involve? It involves who's authorized to do what. So you want authorization coming from people with different levels of authority. The bigger the transaction, the bigger the particular action, you want people with higher authority to have the authorization to do things and to authorize other people to do things. You don't want duplication of duties. You want people to be segregated, so one person can't authorize and execute an entire transaction by themselves, because then there's no oversight. So you want to have a step-by-step process that, while it is not too cumbersome, meaning it doesn't become ridiculous about how much red tape there is, it still has checks and balances along the way. So it's not just one person doing everything, because if that one person then either makes a mistake or commits fraud or something, it's harder to detect. Okay. Also, all these things would have a record. So the book, I know, talks a lot about paper records and things like that. And yes, there are still lots of paper records, but of course there are also digital trails for when people authorize certain transactions, right? There's a digital trail that follows that transaction as well. Again, going back with banks, barriers to it. So physical barriers, people can't just walk into the vault. Only certain people walk into the vault and access, cash reserves. If you think about like a safety deposit box, there are certain procedures that the customer who pays for the box goes into a certain area of the bank, and the bank manager or whoever has the key for it would then bring that safety deposit box to a safe area, and then the person whose safety deposit box it is, or who they rented, they have a key along with the manager, and they both open it, and then the manager would leave, that kind of thing. So there's procedures about that barriers as well, virtual barriers like password gates and all that kind of stuff that you have to get through to get to certain levels of security and certain authorizations. Okay, and then there's always some kind of process or person whose job it is to make sure all those things work the way they're supposed to. Okay, so there's procedures that are reviewed and updated and followed. Okay, every school boards have that as well. Okay, school boards have all this stuff, by the way. Anytime that there's purchasing done through the school board, there's all sorts of forms that are laid out. There are people contacted. All these things are on some level in the school board level as well. Okay, so what are the limitations of it? So basically, you can put in tons of security, and that's good, but at some point, the cost of having that security is not worth the benefit of the security. So if you're a small operation, you're obviously not going to build, a 20-foot fence for, a gardening center that you own or something like that, maybe a gardening center, well, I don't know. But basically, your level of security and your amount of procedures, you got to match how much benefit it's going to bring. You also have to, again, with the whole idea of segregating duties and things like that, what is the risk of collusion or corruption? You know, if two people work together to defraud the company, or if two people make a mistake or something like that, you know, do you have some kind of control over that? What do you have available to you, both physically, virtually, and monetarily? How much can you afford, of course, again? Do you have physical barriers that you can put up to limit access to certain financial records? And then what are the virtual ones? What is your ability to lock things behind passwords and different things like that? Okay, and then how reliable are the people involved on the whole? You know, how well do they have to be trained to use these things? How likely is it that they're going to make a mistake? It's just stuff like that. How much can you trust the human component of this? Because people are going to make mistakes. That's just the way it works. But yeah, I mean, how much of that has to be built into your overall plan? Okay, and then now looking at the control of cash in itself. So cash, again, we'll just talk about a bank. So who has access to actual reserves of cash? So if you, I don't know if you go to a bank, but if you do, you know, banks each have a cash drawer, you know, just like at a store. But their cash drawer only lasts so long if people keep making withdrawals, and they don't, you know, they run out of funds there, or if they need, they only have a certain limited amount of, say, like US cash and stuff like that. They also have a safe that there's a timer placed on the safe, so they can't open it right away. They have to set the timer, and while they do that, you know, they're waiting with continuing the transaction, and then the safe timer goes off, and they open it, get out the stuff. They have to get out, you know, let's say $500 US or whatever. They'd make indications on slips on pieces of paper of what they've taken out, and they put it back. And at the end of the day, they have to count all that stuff and make sure it all is there. So that's the documentation part of it. And so you'd have to match your documentation you have, maybe tick sheets or maybe tracking sheets that are done by hand, and you have to match them with the computerized, like the printout or the screenshot of your daily business. So your cash drawer would have to match that. So that's just scale that up for, you know, the whole bank or for big business or anything like that. Like that's the same kind of idea. And the daily counts happens daily and throughout the day to make sure all those things are accurate and all those things are being followed. In terms of payments, okay, so they want to limit the amount of cash that is used for payments. They want to use checks. They want to use authorized transactions, things like that, things that have and create a paper trail, and things that are not transferable to. So instead of paying a bill with cash, then you go out and, you know, you buy a bunch of lottery tickets or something like that. They don't want that to be able to happen, so they use payment, things for payment that can be only used, you know, to pay for the particular thing that they are intended for. So a check made out to a certain person, a computerized transaction like an e-transfer that goes to only a certain person with the code, whatever. There's lots of different things how that works. They also need some kind of tracking system to make sure that the payment was released and that the payment was received. So if you do an e-transfer now, you know, you get a message and you get a code for your transaction. So there's a transaction code that you can look it up and see that particular transaction, and also you get an email that notifies you that so and so, whoever you sent the money to, has accepted that payment. So you have that matching your bank records, and you can put all those things together as a control over your payment. So that's kind of the modern day version of the rubber stamp you see in the slideshow where it says paid, right? So same kind of idea through that. Okay, so now looking at Petty cash. So I talked about petty cash, and petty cash is for things that are relatively inexpensive and need to be refilled. You know, it could be daily, it could be just whenever it happens. They don't want to have to go through a long procedure, so that's why it's petty cash. So the way it works for us, they establish the fund, they use the fund, they replenish the fund, and they may change the amount used in the fund. So this is this red number should be over in the credit side, but this is the establishment of a petty cash fund, right? So you've got your debit to the petty cash, and then your cash, because that's where it's coming from, is credited the $100. So that just establishes the fund. Okay, and then it goes through the normal transactions throughout a certain period of time. So in this case, they used some of it to buy stamps, they used some of it to pay for freight in different ways, and they had miscellaneous, whatever that is, $5. Could have been anything. They need a box of pencils, I don't know. So they've spent $87, so then they have to replenish that because it only has $13 of the original 100 left. So that's where you get your cash 87. So those debit transactions, as they've used the fund, have to match the replenishment from cash. So that's the way that petty cash one works. Here's another example. More postage and freight, more miscellaneous. Cash over and short. Okay, so sometimes that things are not exact in terms of petty cash, are not tracked exactly the same. So sometimes there's $1 or so missing, and that's what cash over and short is used for. Okay, so that's what you're going to be doing in terms of the actual accounting part of it, right? So establishing the fund, and then debiting as you go through, and then you reestablish the original total by making another credit to cash that counterbalances the transactions that are made. Okay, and for the bank part, I'm not really going to go through this stuff. Bank statements and stuff are now all virtual. This is kind of like looking at matching kind of what they used to do with balancing the checkbook, and that's kind of gone away because people don't have checkbooks as much anymore, but you still should be able to look at your bank statement and reconcile transactions. Now, it used to be that a transaction would appear on your bank statement before it happened. So you might have say a check for $500 or whatever, but it hasn't been cashed by the other person. So on your part of it, it shows $500, but until it's actually taken out of your bank account, you don't count it as being cleared. So that was part of this whole idea of reconciling your bank statement, right? Is making sure that your stuff is balanced and that you have all of the payments and everything that you need that are cleared. This stuff, outstanding checks, right, not been presented and paid to by the bank. I basically would say in terms of this stuff, you're just going to have to go and do the different questions to kind of get the hang of what this is talking about. So this part, just making sure that anything that is done in terms of reconciliation, hold on, I think it's right here, yeah. So anything for the books is definitely journalized and posted, and then the bank side of it is not journalized as well. So these are things to understand which side they go to per bank and per book side. So bounce checks, so that's NSF is non-sufficient funds, so you didn't have the money for the check, so it bounces is what they used to call it. Basically, instead of cashing a $500 check, they don't get any money, and then you get dinged for a charge. You get charged for not having the amount of cash available you should have had. Anyway, the best thing for you to do is go through this stuff, make sure that you're able to balance back and forth between the bank and the book statements, making sure that they are what they should be. But yeah, do the questions for that. Okay? Alrighty. Yeah, have fun.